You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. Today, we got my guy, Thomas George, the famous, the infamous, two first names. Me too. My last name Thomas, my first name Daryl. Your first name Thomas, your last name George. So we on here again. How you doing?
Oh man, always a pleasure, Daryl, man. Thank you for the invite. Always good chopping it up.
Yeah, for sure. So Grizzle's been doing some work. You obviously operate the ETF disruption at a reasonable price.
Correct. The sweet spot of disruption.
Yeah. So you were heavy into NVIDIA. We were talking about 2 months ago. This is before we shot up past $1,000 and did a stock split and everything. So I mean, you were spot on with that call. Y'all were like, hey, this is going higher.
Yeah, well, so we were like one of the ETFs, the top holders on a percentage basis of NVIDIA. That basically, like, it was out of all ETFs that were, and basically we're the only active ETF with a massive position in NVIDIA, right? So the others would be like a semiconductor focused ETF, et cetera. But like, and those were all like passive ETFs, right? But we were the largest position. To put it another way, so I don't know if you followed the drama around, basically BlackRock has the iShares, their technology sector ETF.
Mm-hmm.
These passive ETFs, I think we're coming to the end of the line of this whole thing, right? So we had going into earnings like in 19-20% position. That was before like real liftoff, right? We were talking about it before, right? So like we were really nicely set up before that. So we had a nice rally. We've trimmed some back, but we're still heavily we still have a very big position around 19. But like obviously we trimmed off the top. But what's really interesting, the drama in this section, this is why we believe DARP makes a lot of sense, disruption at a reasonable price, active management makes a ton of sense, because right now we're starting to see cracks in the system, specifically around these passive ETFs, right? It's kind of like these things are like, okay, you just put it in these things. They become trading vehicles. People don't think about what's inside them. They're just like, just buy the biggest tech thing. I'll have tons of exposure to NVIDIA. So this is big drama right now. We're going to put out a piece on this. So just kind of giving a little bit of a precursor here, but this is stuff that the industry won't talk about, Daryl. Like, you know why the industry won't talk about it? You never bite the hand that feeds you, right? Like, so big ETF sites and all this sort of stuff, they'll never really talk about what's going on here. Other industry ETF observers, they're never going to bite BlackRock's hand. Like, why would you do that? Like, right? I don't care, because this is like just no, like I have no relation to BlackRock, nor will I ever. So this is the truth that people got to understand, is that what's happened with BlackRock is just incredible. So there's this rule where your top 3 holdings is a regulatory rule, can't be more than 50%, right? So they made the decision, and it's not, so it's a combination of BlackRock and the S&P indices, right? Because the BlackRock is basically, they take the indices from the S&P. What the S&P did is to say, oh, listen, I'm going to use BlackRock and S&P interchangeably. It's this thing is a massive ETF, right? And basically what they did, it's just incredible. They've capped NVIDIA at 6%. So get this, they decided, it's a passive ETF. They've decided that Microsoft and it was Microsoft and so there's two top holdings, right? And so they were saying like, oh, listen, we'll just cap NVIDIA, right? It's like it like makes no sense. So Microsoft and Apple, they capped at 10 and change, and they said, oh, we'll just cap NVIDIA. So anytime NVIDIA would go up, they would just keep trimming it back. So you think you have exposure to a market cap weighted exposure to AI, but these numpties have ended up capping your exposure to NVIDIA. Then, last week, they make a thing. They're saying, yeah, you know what? And obviously, they're not admitting they made a mistake. It was just total F up, right? This is a total F up. They're like, oh, okay, listen, now we're going to increase the weight of NVIDIA to 20% and pull down the weight of Apple to 6 or whatever. Like, so just total craziness. But this shows you exactly why active management is back and why it matters, right? So this is the opportunity where funds like ours, we were ahead. Like, this is the opportunity where we think the pendulum has swung, and these kind of passive ETFs where people think they're getting exposure, they're not really genuinely getting what's inside. And I think we're at that opportunity. I know, like, you interview a lot of people that are taking active views, and, but when you flip on the other side, right? Like, there's our little world of people who are making bets and taking calls. But then when you think about the weight of money, that weight of money is all towards the BlackRocks of the world, which is like dumb money. And they charge 4 basis points. They're like, well, you can't go wrong with price, except, so we ran the numbers on this. That's cost investors 7% this year. Their stupid decision that they would say, well, it was an index decision. We're not an active ETF. Here's a 4 basis point, product. It's cheap. Well, cheap has a cost, right? And that's cost 7%. So that's my little rant. But that's the truth. And I think we're on the cusp of something massive here with respect to these big players, specifically passive, that are pushing off product that are ill-designed, bad decisions, and no one's calling it out.
Yeah, and so and a lot of people, they buy the ETFs because they want to be diversified, and I know that we're in a different environment where there's winners and losers, right? We've always had winners and losers, but now it's like, okay, it's critical where you put your money. And so with these types of funds that may hold like a 6%, percent weighting to NVIDIA, when NVIDIA is like, I mean, the whole narrative earlier this year was around, AI, chip stocks coming back. I mean, we saw massive price increases from NVIDIA last year to this year. I mean, there was quite a few other semiconductor and AI stocks as well that ran significantly. AI cryptos ran like that whole narrative was just so strong, and to like keep it at a 6% doesn't make sense at all.
No, it was a real, like, it was such a crazy setup where basically, they capped big returns, right? And so this is kind of, I think this really ushers in a new paradigm, a new opportunity where stock pickers are back, right? Like the jockey, and that's kind of what I've always, that was been our mantra: stock picking's back, right? And listen, Kathy Wood, and a lot of people, dogged, obviously there's a lot of nonsense there in terms of at least the way she looks at it. But let's to put it in perspective, what she brought back early on was stock picking, right? And right, whether you agree with her view or not, she brought back and focused that stock picking matters. Now, obviously, we have a view that she's disruption at any price, big shiny object, no potential earnings for the next 10 years. Like, that's her kind of fishing pond. We don't think that that's an attractive place, but that's an active decision. You understand it, and you kind of like, you can kind of decide to yay or nay. I'm not gonna, but the other side for us, we're like, hey, listen, there's a sweet spot here, disruption at a reasonable price. You want to own a collective of assets that have this real torque for free cash flow then in a 4 to 6 year period, right? We're not talking science experiments. We're not talking shiny objects, man on the moon mission stuff, right? Like, that's all, like, that gets people's like juices flowing. But in a world for higher for longer, which we are certainly in, we're not going back to like ZERP, NERP, like we're not going back to that world where interest rates are going to stay low forever. Like, this is a higher for longer. And what that means in disruptive investing, very specifically, is that means the science projects go away. She's down. I always just check, rear view. We're up like 20% and change. I'm like, I'm like, what's going on in disruption at any price? What's happening over there? She's down like nearly like 18% this year. Like, it's a gong show. And the thing is, like, listen, she's still getting all the media, this, that, the other. But what you have to look at is units, right? Units of ETFs, which is basically the creates, right? And I'll explain it. So these ETFs, the way they work is like, as more people buy them, they create brand new units, right? And so and then so you can follow the chart of those unit creates, which show you the net demand, right? And so what was interesting is through all of that gross underperformance in, we all remember it very well. 2022 was a disastrous year for her. There was no net selling of this thing. And then 2023, she had a good year, but like can't make up for like that disaster of 2023. But then this year we're starting to see capitulation. We're starting to see people start to sell out of this thing because you're seeing unit creates going down, right? So there's redeems happening, and that is a sure sign that strategy at the core of it, investors are just they're throwing in the towel on this, right? So it's, I kind of joked around where, people are like, oh, hey, she just came out with like her new Tesla model and this, that, the, and it's just nonsense, right? But the most important thing, people are like, well, she's doing it again. She's getting the media attention. People are excited. I'm like, dude, those unit creates are going down. And this is what happens. It's a great thing in asset management. Where people say all publicity is good publicity? Not in money management. Not in money management. In money management, she's at that amazing point where anytime now she goes on, people are like, what is this nonsense? And that's happening because we're not in a ZERP world. Everyone now understands, just like your mortgage cost is higher, just like all the other things are higher, like, do these ideas even make sense in a higher for longer interest rate environment? And that's what, we're seeing a real dramatic change there. And so we believe that AI, and she hasn't been in the AI space at all, but we believe fundamentally that AI is the sweetest spot of disruption at a reasonable price. You've got companies and everyone's like, oh, well, NVIDIA's, PE and this. Listen, we're nowhere near close to where the PEs were for Cisco and the bubble and et cetera. And secondarily, people talking about pets.com and all the .coms that there was actually nothing in the underbelly of that initial wave of internet build out, right? That was driving those valuations because there was no real fundamental earnings underneath it. In NVIDIA's case, obviously there is real earnings. And then more importantly, there's a functional use case for AI. We're seeing it every day. And it's those, and I follow a couple of people that are good at focusing up on AI. And I think why I think is so important is that people that get it are integrating it in their daily, right? Like they're integrating it in their daily, how to incorporate it. And those that don't, just like, it's a bubble, this, that. And I think those that integrate it get this the best.
Yeah, for sure. I just want to share it because I was just fascinated, so I had to go look it up when you shared this. So this is the ARK-K ETF.
Yes.
And overlaid is the DARP ETF.
Yeah.
As you see, DARP is up 23% on the year to date, and then she's down 10%, 11%.
Yeah, so she was down as much as 15 and change. Like it's a bad situation for her, right? This is a good year. This is the definition of dark, why valuation matters, right? And we're not value sticklers. We understand that growth is just as important. I think that's why small cap value has been, in a structural challenge place. Same with mid cap. These are businesses that can't grow top lines, and so I would say got to be careful. So that's kind of, from our perspective, this is the real test here. And I think the DARP ETF is the highlight of that right now, 65. So what the strategy we're running is the barbell, which we call the barbell of tech and disruption of tech, AI technology on one side of the barbell, and the other side of the portfolio is commodities of the future. And I think that is a phenomenal construction that brings both great value and on the commodity side, there's tremendous value. And that's what most futurists I consider, running DARP, we're futurists. We're always thinking about the future. But here's one thing. You go into a big room. We were just at a massive tech conference in Toronto, Collision. Ask anyone, they could talk your head off about AI car, autonomous cars, this, that, the other, blah, blah. You're like, okay, let's rewind a little bit and let's talk about the commodities that go into this, future that you love. And they got nothing. They got nothing. Like, and they're like, okay, listen. And so that's like, I think that's an opportunity to exploit as an investor, because the futurists like have one big blind spot, is that they have no concern nor an understanding of the fact that the elements that go into your, blissful future vision, wherever you have zero understanding of the supply demand of that side. And here's the value opportunity for investors that, go into that area, is that these guys don't look at it. So Tesla's got a massive PE, but our mining stocks, like lithium stocks trading on single-digit PEs, right? I'm not saying you don't even have to go into the juniors and this, like just even if you just wanted to create we had a Marago Resources, our top position in the ETF earlier this year, still a bigger position, but that was trading at like a double-digit dividend yield. like you could have bought it, set it for the rest of your life, and had it there, right? And that, I think that kind of, and that's just, so they're in copper, right? And so I just think that there are just these glaring value opportunities in commodities that are real. But I think the other side of that too is that you got to own the barbell. Like, you got to own tech. Like, don't be so focused at so many people that I talk to in commodities are very, very focused on the, okay, hey, listen, here's where the value is. And I'm not going to, dip my toes, so to speak, into tech. And I think that's I think that's an incorrect move. And from a perspective of A, yes, you're right about the value of commodities, but B, the growth, the fundamental growth that's happening on the technology side, and what's, what is going to be ushered with AI. You don't want to miss that, right? You don't want to be like, waiting for. So I think that portfolio construction of the barbell of tech, AI on one side, and then deep value commodities that still have structural growth, there's no doubt, on the other. So that, that's the opportunity. And we just put out a piece today on uranium.
Yeah. So I want to get to that. So I was going to ask you, I was just going to add, and it's important, like, because obviously, commodities have been, some commodities have been rising. I mean, like, you got physical gold, but the miners have been just lagging significantly. Yeah. And that's the importance of like active management, because I mean, when you're watching the trends, you're watching, what's happening right now, like NVIDIA and all these other companies, like they're going up significantly, right? So why would you miss out on those gains? And I'm sure that when commodities, you have some commodities in here. I see hot chili right there. Yeah, that's top 10 holdings. And they're going to be at the Real Symposium where I'm going to be at.
Oh, good. Yeah. See, I had a Christian from me. Christian's great. Like, Christian's phenomenal, man. He's got he's the CEO of Hot Chili, such a great handle on the fundamentals of copper. Plus, he's sitting on probably one of the great growth assets in the sector, which is basically a space that has very few assets like he has, right, in Chile. So it's top.
Yeah, for sure. So I'm seeing the commodities in here, and I'm sure, like, with active management, as things shift or things move, I mean, because you have these capital cycles and stuff, and so right now a lot of people are in major profitable tech. I mean, when that becomes unprofitable, that money rotates and stuff. And so, like, with active management, I'm sure you're watching those types of things. Yeah. Like, where's the capital cycles they're at, and where's that transitioning to? Is that correct?
Yeah, Daryl, you hit it right on the head. And that's exactly the piece we put out today. Basically, so at research.grizzle.com, you can find all our bits. But we just put out a piece, uranium, an attractive relative value setup, plus the optionality of M&A. But to your first point, so here's my, the first, our first intro here. In the face of AI and technology, stocks rallying what seems like on a daily basis, right? Like, this is like everyone's seeing every day, these things are going up. Uranium feels like the forgotten stepchild of growth, right? Like, this is like, and you can kind of feel that, right? You're like, forgotten stepchild. So we believe that this there's an opportunity here, and we found there's a good graph. You scroll down, you can see this graph, which we've said it's interesting because uranium stocks have done well, right? But they have this almost perfect in an upward trending channel, right? I'm not talking about stocks that just go down. The uranium stocks go up, but in an upward trending channel, they have this almost negative correlation over short periods relative to tech, right? So we looked at, let's look at this, this spread, so to speak. And I'm just using the URA ETF as a bellwether. You can use any other ones. It basically tells the same story, but you're trying to grab a basket of stocks on the one side, basket of stocks on the other. And you're looking at, okay, listen, there's a relative story here, right? So when their performance, there's a significant differential in their performance. Historically, over the last year, we look at this trend. You've seen two periods, right? You've seen a period in August 2023 where basically it reached this low point for uranium stocks, which is at lower end of the graph. And then what you end up getting is almost as rubber bands swing back. And then over the next couple months, you get 28% return on an absolute basis, which is phenomenal. And then we saw that again earlier this year in March of this year. We saw the same setup. Again, like that, where you get this, everyone's forgotten about uranium. And then, sure enough, and then you get this 23% return in a very short period of time. And lo and behold, the last little dot there is where we sit right now. We're back at the same relative price point of uranium versus tech. So it's a low point. And we think that it's an exciting setup. Now, what's the catalyst? Like everyone talking about, well, it's nice that you can find these spots, but having a catalyst behind it is almost the perfect setup. And we've had that, right? So the Paladin's announcement of their acquisition of Fission Uranium for $1.14 billion, that's the M&A catalyst. M&A is a phenomenal thing. Now, I posted it, people are like, listen, the price sucks, like obviously people want more money for this stuff. But what I'm seeing is, listen, surely you just don't own only fission uranium. And that's why owning things in a portfolio contest matter a lot, right? Own a few of these things because it's going to benefit your other things, right? And the way to think about that is, yes, you may not be entirely thrilled with the price because, we're still seemingly early innings in the long-term structural trend of far more nuclear power, and uranium assets should be bid up much higher. But you're going to get shares of Paladin. But the other side of that is that, listen, okay, forget about the takeout value. The bigger opportunity here is now that's put a line in the sand. It's put a clear line in the sand of what an asset is worth for a small cap company and micro cap companies, right? So now we have the line in the sand, the valuation, EV per resource, that then tells you, okay, now you have a line in the sand. What other shares are here? And this is the opportunity. So I always think about who's my incremental buyer. I'm always thinking, I'm like, okay, I'm sitting on an asset here. I'm sitting on a sector. I'm sitting on a stock. It's not just good enough for us to come into a room every day and be like, hey, check this out, chat every day about how cheap this is. I'm talking to you. We both own this thing. Like, doesn't matter, right? And the point is for us to convince the other person who's the incremental buyer. And that incremental buyer is not the uranium investor. We're all investors, like the uranium investor group cohort is already established, right? So you're looking for that incremental dollar, and the beauty of M&A, it brings eyeballs to the sector, right? You're bringing generalists to the sector. You're bringing big PM money to the sector saying, wait a minute, what's going on here, right? And so where's the easiest way to shake money out from two small caps and micro caps? It's getting people to shake out their position in the chemicals of the world, because they were like, hey, listen, steady Eddie here. Now they're like, wait a minute. If M&A starts the party, and it always does, well, maybe I should have a bigger weighting in these small and mid caps, right? And then secondarily, okay, well, Paladins draw the line in the sand for dollar per resource. So now I got a good kind of like lower bound, right? So now you can start to say, hey, listen, now let me look at the characteristics of the types of stocks that that obviously Paladins bought, and let's look at historical M&A transactions. What have corporations been buying? What have the valuations been? And you back all that, and you're like, okay, listen, now I'm looking for these characteristics. I've got valuation support. I'm not buying above the EV per resource, right? So I'm not buying over the price that Paladin paid and what recent transactions were. So I want to be on the bottom side. And it's all about risk management, right? And risk management is the name of the game for DARP. Disruption at a reasonable price, what your resources at a reasonable price, whatever you want to call it, you have to stay at a reasonable price, because once you kind of get caught up in the hype, you're like, okay, I'll pay anything. I just want to be in the ball. I want to be at the dance. That's when things get off. And that's what we saw obviously with ARK, their ETF. And that's how you see with a lot of things, right? Where you're just like, when valuation doesn't matter, that's when things get a little hairy. But I think in uranium, you got a huge opportunity here, because you got real M&A happening, and you got a whole host of companies that, that could be in that sweet spot of being under that valuation umbrella. So we highlight 5 names in the report, looking at what we think are really interesting opportunities that could warrant interest from a valuation perspective. But I think bigger picture here, this is the opportunity. I think, small cap season is definitely here because M&A makes it so.
Mm-hmm. And when you say M&A, that's mergers and acquisitions. Is that correct?
Correct. Yeah. So that mergers and acquisitions. Yeah. No, for sure. Like, and that's kind of like in commodity land, that's always been when you think of super cycles, the party really doesn't get started until you start to see a level of mergers and acquisition, M&A, right? Because that's kind of like then when everyone's like, well, wait a minute, if you're a bigger guy, you're like, oh, those guys have done that deal, I need to find a new dancing partner. And then investors, like, that's from a corporate level, right? Because the corporations are like, yeah, if their resources are here, they pick that off super cheap, I got to do something similar. And obviously that, that starts to bid up the price. And the second part about that is investors obviously are taking notice too. So they're like, listen, I'll get in on this and make sure that I'm finding assets that are super cheap. Maybe trading at a fraction of the multiple of fission uranium, right? And so those are the types of opportunities that present themselves. That's why uranium is so interesting. And I think the opportunity is always that we're going to continue to see structural good news from the sector. So I think, and when you add on the icing and the cake, the M&A, the mergers and acquisitions, I think it gets quite exciting.
Yeah, for sure. And Thomas, before we wrap up, I want to get your take on the markets. I mean, there's a lot of concern. There's been a lot of talk about recession, a lot of talk about unemployment, and markets hitting all-time highs. Nasdaq, S&P, and stuff. And so, like, what are you seeing there, and like, how do you factor that into like the active management of DARP?
Yeah, so I think the setup is great for those owning risk assets right now. Like, like literally, yesterday, whatever happened to Biden, like that's if you're an investor, right? The Trump side of this is as free market as it gets, right? It really is as free market as it gets. That basically, you get that value line.
So, Thomas, leading into this conversation, there's been a lot of talk about recession. There's some people have been, de-risking their portfolios. We've seen markets hit all-time highs. We've seen S&P, Nasdaq, and everything. And so, how do you factor in, these other factors of like, okay, are we going to get recession? Are we going to get a significant pullback? Because the markets don't go up forever. And so how does DARP, being more focused in active management, how do you all factor in those things?
Yeah, good question. And so from our perspective, I think we have a great setup for stocks to continue to be on the trajectory they're on right now. Specifically, we're going to see we're at the top end of the rates. Like rates are going down. So that's obviously a tailwind here. Like that's something very real. And we know that's always a good spot for commodities. I know gold equities haven't done what the market wants them to, but we think that that's an opportunity. But gold itself is telling you that it's this is still a very attractive space for commodities. So that side of it. So from our active perspective, I think that side of it is very exciting. We think natural gas is super, super cheap. Like, no one can tell me 10 years from now, natural gas demand will be less than it is today, right? With oil, you can be like, okay, well, is there more hybrids or whatever? Like, there's question marks. We still think that those get, there will still be more oil demand. But with natural gas, The world, it is the future fuel, and the world, world will be on a new platform for energy fully globally. And that's going to be a combination of natural gas and nuclear. That makes a ton of sense. Nuclear is obviously the final end goal. Now, on the tech side, that's very interesting as well, where we think the AI portion of it is immune to it, because you got these massive mega cap companies that are spending, and they may have to spend for years. They may actually have to spend billions for years to compete on this level. This is the build out phase here, and that's irrespective of economic cycle, right? So if I'm looking for buyers, I don't want that guy who's looking for a value meal, right? I want that deep pocketed consumer, which is Google's, the Microsofts, the Facebooks that are purchasing from NVIDIA, that are building these LLMs that, this is a CapEx cycle. They've got enough cash to last 1, 2, 3, 5 years. Like, they are price insensitive as it gets, right? And I think for them, I think people lose a lot of focus here. Mark Zuckerberg, like Google, all of these guys, their concern is not, oh, well, what's the analyst going to think when my CapEx is still high for the next 2 quarters, versus I didn't spend the money to train these models because I really wanted to manage to this 1 quarter, right? And I miss out, and I put the entire business at risk, right? And right now, make no bones about it, Google's facing an existential crisis. They are, right? Search could be redefined as this is, so their proclivity to spend as much on R&D to, make sure that they're ahead of the curve is maximus. Same for Facebook, same for Meta, same situation, same for Microsoft. We are at a juncture where the amount of money that will be spent on this will be significant from the most deep-pocketed players in the entire world, right? And so that, I think, immunes you to a recession. Now, without a doubt, what we say is, listen, own the barbell. Makes a ton of sense. The mushy middle is going to have a challenge, right? And I think that's the, why do I want to own banks right now? Why do I want to own marginal consumer companies? And, all this sort of, there is definitely going to be pockets where you don't want to own. That's why I think the DARP setup of the barbell makes a ton of sense in general, in the conceptual thinking. That's why. And, people say, well, that if there's weak consumer demand, surely that's going to impact commodities. I'm like, listen, have you seen commodity stocks? They've already baked in the next decade of no consumption. So, I think, the commodity stocks are interesting because they've already baked in an element of lithium's a great example. They've already baked in something very much so a negative outcome.
Yeah. Gotcha. Yeah, that's good. Appreciate you sharing that barbell approach and being able to, you're owning the growth, and then you're owning the value, and okay, these commodities are they're gonna grow soon. The commodity cycle, you could see parabolic moves too.
Yeah. And those, to your point, with commodities, right? You can't just join the party after. You kind of have to find your seat, before. There's no question. I've never been able to, play a parabolic move. I've sat in the seat sometimes where I catch it and I feel really good. And the discipline is you got to sell, you got to find your point to sell. But the point is that it's very hard to join the party after these things have moved, because they move rapidly and really quickly.
Yeah. Gotcha. So I'm gonna be sure to link this article in the description. You all be sure to go check it out. You can even sign up for the 7-day free trial to get the 5. Can you put 5 stock picks in there?
Yeah.
So you do y'all a bone. Be sure to go check it out. Where else can people find more about you and the work you do?
Yeah. So for the research.grizzle.com, for the ETF, ETF.grizzle.com. And then obviously we live on, we live on Twitter, man. So yeah, that's where I'm putting out all the little pieces. Oh, and then I forgot to mention the other piece, the tailwind here is that, what we saw with Trump and Biden, and however you want to think about it, everything aside, the other tailwind here is that, on a relative basis, Biden's going to be more restrictive, he's already, from a corporate perspective, and, at least from market perception perspective, anything that tilts in the favor of Trump is good for the market. So that's all, that's its own tailwind. But
the whole tax cuts debate and all of that. I mean,
Eh,
that's gonna, you know,
Exactly. So, yeah. So you put out. They're always appreciate, man. Thank you so much for having me come through, and it's always great to chop it up.
yeah, for sure. We'll do it again.
Yeah, I appreciate it, man. Thank you.
All right, take care.